I'm going to cover a quick video on the different types of days that can happen that we're looking for. There's really 3 or 4 types of days, and those can look something like this. So the day starts out and we have an initial pop-up, a pullback to somewhere like this, and then we come back up, revisit this, and we'll just kind of go like this the whole day and finish somewhere like this. This is like we would consider a range bound day. You never really broke around this area and down here, and so you might trade it, and you have to wait on this type of range bound day. And this is maybe a range bound rotational type of day. Either one of those are a good term for it, because you're rotating within this range here, and you have to generally wait for the range to be established. You got to know what that range is before you can trade it. And so these are days where you need to give the day patience and time to establish that range. A second type of day is a failed breakout, where the market opens somewhere here, and it'll go up outside of this range, and that range could have been from the previous day. Let me do it like this. So let's say that the previous day had gone up here like this and down, boom, boom. So we have some kind of volume range that we're looking at. And so this right here would be maybe like right there. So today, price does maybe a little bit of a pull down to this range down here, up to here, takes out the stops from the previous day, these stops right over here, and then comes back in. And it can either come back in and then do this, or another scenario is failed breakout, which comes in, goes up, and then just falls out of the sky. So that's another one. And of course, it can go either way. It could market opens here, pops up, and goes down. Boom. Now, the difference between trend and range bound, or rotational day. So rotational, we're doing something like this. Boom, 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 whatever. That's rotation. Or chopateria, anything like that. Trend is, let's say the market opened, pulled back, and then just does this. And basically what that looks like is on your time frame, like a 15-minute or 30-minute, there's just no pullback. Every candle finishes above the other candle. And of course, this can go up or down. And these days, you never try to go against the trend. You wait for some kind of pullback like this, some kind of little consolidation, and you get in with the trend and follow it. Or you never trade, either one. I'm going to show example number 1. We'll use today's price action. Today would have looked like a trend day, but it actually wasn't. The reason being is, so at the beginning of the day, before the market opened a regular trading hour, so RTH, which is 8:30 Central Time. So pre-market, there at 7:30, economic numbers came out, and that caused the market to spike up a lot. 300 handles, insane move. But when we look at the rest of the day, and I'm using 3-minute candles to show this, but it doesn't matter. I could use 1 minute, 15-minute, doesn't matter. What I want to show, actually, okay, I'm going to go to 5-minute. It's a little easier to see, that's why. And the reason why is that when our market opened at 8:30, right here, we traded up from here to here And that basically established our range. And then we trade within that like this, and we finish back basically in the middle. There's a couple things to understand about this. I drew a line here and here, which was really the established range. So we had this red candle here. We had this high up here, which really could come down to this red candle. This was our established range. So if you were to take a trade and you hadn't taken the trade yet, you could wait for this red candle to come down. Then you would take a long, and you'd wait till this got established, this consolidation right here got established. And really you're looking for this red candle, a takeout of any potential shorts, and then you'd be short here or get out. So at this point, now you're expecting the short to come down to here and take out the stops down here, because we're always looking for where are the stops, because that's fuel for the market. So when it comes down to here, you get out, close your short, or you go long. But at this point, the market is consolidating, or what they call mean reversion, or anything like that, or chop. The reason being is because we go up to high, take out the stops. Go low, take out the stops. And it just trades around here. Too high, too low, too high, too low. There's things to understand about this. And then at the end of the day, we touch VWAP, which normally it's just something like, oh, it's a notice. It's not something I trade around. A lot of traders do. I don't, but it helps me know where we are in the day. If I add back the volume profile for the day, there's things I want you to understand about this. So the green area is where 70% of the volume traded. Out of all the volume for the day, 70% of that volume was in this price range, from the low area right here, the low of the value area, to the high of the value area of this price range. Outside of the 70% is the extremes of it. So we're looking for where those extremes are, and we're going to trade around those extremes. But this was not a trend day. This was a chop or mean reversion or rotation day. Anything like that. Now, if we go to another day here, let's see. Monday, it started out with a gap down. What did we do? Took out the stops out of this consolidation right here. Then we go up. We come back up to almost settlement, which is this line right here. And then we chop around the rest of the day. So really, you could have gone short, then long, and be done for the day. Anything else would be miserable. Friday was another, but this was an actual trend day. And the reason being is, so things chopped around until the 9 o'clock economic, or 9:30, I guess, economic news. So we kind of go up, we pull back, and then the news takes us off. And what's important here is what they call one-time framing higher. And it really was on the 5-minute, on the 15-minute candle, anything like that. And what it means is every candle is a higher high and a higher low of the previous candle. And from here to here was one whole move. Then from here to here. And if you go to 15-minute, they never are overlapping the previous candle. So if you look here, I went to 15 minutes for this Friday. Here's our pullback, and look, every single candle, higher high, higher, nothing pulled back. So you would never ever short this day. There's no reason to. If you do, you're just going to get nailed. Another kind of day. This day, we chop around, we break higher, and then we come back in and trade down below. So this would be a failed breakout. And we have these previous days here that are in the price range or the value area. They're overlapping. This broke out of the area, came back in and back down. So there was no direction. We're just chopping around. This day right here is a V day, V reversal day. So we break up, break down, take out stops, and then break up. So you could potentially have one trade,
2 trades, 3 trades, or 2 trades. Wait for the pop, take the short, go out, because it was a failed breakout, and you could see that because of these candle. There's a wick here and a wick here. You would go short. Let's see. Here's another day. So we go up. Here we got this wick here. Okay, didn't go anywhere. Now we're looking to go short. And then we have this consolidation, lower highs, meaning right here. All these are lower highs. Boom, boom, boom. Short. And down to here. And then you get out and you're done for the day. Or you could try to squeeze this out, but you never know if it's going to be reversal or not. Sometimes you can tell depending on the other stuff. So that is really what the main meat of almost all the trades. There's others, but it gets trickier after that.